Good afternoon, everyone. My name is Alana Brown. Over to that way is Eric Restrepo, and we are here from solo401k.com and Nabers Group. Today is Wednesday, October 27th, and we're going to conclude our 5-part contribution webinar series. I'm sure we'll do some more contribution stuff. This has been a real big hit, and contributions are tricky, so this will not be the last of the contribution discussion from us. So today we are going to focus on the Roth 401k, so how to make contributions right to your Roth portion of the solo 401k. As a few little reminders here, we're going to have Eric tell you all about the different ways to get support. And now, as he's doing that, let us know over there if you can hear us, if you can see us. Eric, take it away.
Awesome. Yeah, amazing job on the intro there. Yeah, tons of great ways to get support. Solo401k.net. If you guys haven't joined our private social network, that's where a lot of our clients are. A lot of the prospects also are there. You can ask your questions there. We also post all of these webinar events there. So if you guys want to know what's happening in terms of training, go to that website. You can sign up. It's like a network. So, you can set your notifications. So be sure to turn on notifications so you get notified when we post new exciting stories about what's happening in the markets, as well as new trainings about how you can take advantage of your solo 401k account to the maximum abilities of what's possible. Also, check out our website, solo401k.com. Ton of great resources. It's literally like an encyclopedia for the solo 401k. And then also our knowledge base. So at support.solo401k.com, full-length articles, tutorials, videos, PDF downloadables, all kinds of great content there to help you support you along the way. And a lot of those questions you guys might have, we do typically refer back to that support database to be able to find answers. So if you guys want to get the answers yourself, go directly to support.solo401k.com.
Awesome. Yeah, that's where we're pulling your answers anyway. Some of them are up here.
Yeah.
Perfect. All right. Thank you for that, Eric. And we'll jump in. So guys, while we're going through the presentation, if you have any questions, go ahead and post them down there. Let's try to keep our questions pertaining to the Roth. If we do have additional time, we'll address some other questions that do have to do with the solo 401k. Without further ado,
Awesome. So we're going to talk all today about the solo 401k and Roth contributions. Just a quick disclaimer, guys, just as normal, this is education. This is not financial advice, legal advice, or tax advice. We love doing these educational webinars for you so that you guys can get the most out of your solo 401k. But that being said, if you do have tax, legal, or investment advice questions, just refer to those counselors. So a little bit about Nabers Group. So we did launch the IRA LLC back in 2003 and the solo 401k in 2006. We have had consistent IRS document approval for the past 15 years. The cool part about our team is that everybody here does have a checkbook control retirement plan. So we really do, eat our own cooking, if you will. Also, we do work closely with the IRS and Department of Labor. So any compliance issues, all of that's handled on the back end. You guys don't have to worry about any of that. Also, we're not a custodian, so we never handle your money. So you are your own custodian, so you have full control, checkbook control of your retirement assets. So in today's training, we're going to cover the ins and outs of Roth 401k, the difference between, traditional and Roth contributions, Roth 401k benefits, also the logistics, really, how to put funds into a Roth 401k. So, also we're going to cover, what can roll into the Roth 401k. Really, no tax implications. Previous Roth 401ks, Roth 403bs, 457 Roth, TSP Roth, basically any Roth, any qualified plan that's a Roth account. The only one that can't roll in is just the Roth IRA, but any other Roth type accounts where you had maybe at a job, that can all roll in. So yeah, check out this rollover chart, really super helpful. Basically, with a solo 401k, almost everything can roll in. The only thing that can't roll in is just a Roth IRA. So traditional plans, IRAs, qualified plans, other Roth assets can all roll into the solo 401k. Quick review on contributions. So if you're a small business, if your small business is compensating you, you can contribute some of that money into a solo 401k. Depends on your business structure. So if you're a sole proprietor or an S Corp, depends how you pay yourself, but you can contribute a portion of that into the solo 401k. Contributions can be either pre-tax or after tax, which can be Roth as well. Since you're both the business owner and the employee, you do get to take advantage of those two types of contributions as well. So, and then really without getting too complicated, this is just a recap. There's two basic types of contributions. There's employee salary deferrals. That can be up to 100% of your compensation, maxing out at $19,500. Those can be either pre-tax or Roth, or a combination of the two. The profit sharing is you as the employer. That can be between 20 to 25% of your business's net profits. And that does, again, depend on your business structure. Not typically, that is always pre-tax. That one is never Roth. That one always goes in pre-tax. So maximum contributions for the solo 401k for 2021 is $58,000. If you are 50 years old or older, you do get an additional catch-up, an additional $6,500. So that pushes up your maximum all the way to $64,500. Contributions are based on net compensation. So really, the more that you earn, the more that you can contribute. So pre-tax contributions are made with pre-tax dollars. These contributions are tax deductible from your taxable income. Pay taxes on any funds you'll basically pay taxes when you distribute those funds, right? So that's what it means, tax deferred. It's not a tax-free account, it's a tax deferred account. So when you do pull distributions out of that account, you will pay ordinary income taxes on those distributions. But the common wisdom is that in retirement, typically your tax bracket will be lower. So you'll be able to control how much you're distributing, and you'll keep yourself at a lower tax bracket. So, the question is how much to put into pre-tax contributions versus Roth. It's really, it's up to you guys. It's a personal decision. What's more important? The cool part about the solo 401k, you get to make that decision on an annual basis. One year you could choose to put it all into traditional pre-tax and lower your taxable income. The next year you could put it all into Roth, maybe do a Roth conversion and, pay the taxes, but then never have to pay tax again on those Roth funds, right? There's really, truly no right answer. I think the main point is that we're giving you guys the control to decide year to year, should I lower my taxable income and contribute pre-tax, or should I contribute to Roth and, have those Roth designated funds, when on the back end, never be taxed again. So work with your tax professional, figure out the best strategy. But the great part is you get flexibility to do either one or both in each year.
Awesome. Thank you, Eric. So let's talk a little bit more about Roth. Why is the Roth Solo 401k so valuable? So Roth funds have a special designation that allows for that tax-free distribution of your original investment and the gains. So the Roth IRA designation was introduced in 1998, and the Roth 401k came in 2006. So not even that long ago. So it came from the new advantage for retirement savings. It allowed for these new advantages. Many countries don't even have Roth accounts. So they have to pay taxes on all of their distributions. So it's really great that we do have this ability to make these Roth contributions, so we have those tax-free advantages upon retirement. So the Roth 401k funds are after tax. There is no tax deductions on the money going into the plan. The growth and the gains will be tax-free whenever it's time to cash out and take the distributions at retirement age. So Roth 401k benefits. So with a Roth IRA, you aren't allowed to contribute if you have too high of an income. The Roth 401k accounts do not have this income ceiling. A lot of people ask that question. So this is really, really a huge benefit of the solo 401k. This is very attractive for those high earners that have their own small business or self-employment activity. So if Roth contributions have been compounded dramatically over the years, you're going to get a very valuable tax break. You're not getting that tax break in the beginning when you're making those contributions like pre-tax, but think about at the end when it's time for distributions. That is where you're getting that tax break. So the contribution limits on a Roth. So remember, we mentioned the two types of contributions: employee salary deferral and employer profit sharing. Only the employee salary deferral contributions can be Roth 401k contributions. So there's your visual. The employee contributions, that one is the one that you can designate as Roth. So that's going to max out at $19,500. And like Eric's talked about, the catch up for the $6,500. So you could potentially put $26,000 as Roth. Of course, you can choose that to be pre-tax as well. So it's your choice for the employee. And as you see, the employer profit sharing, remember that is only going to be pre-tax only. There's also no catch up involved. So like we said, the employee contributions, those can be Roth, and that's 100% of your net compensation, but you just can't max out over what your limit is. So under 50, that's 19,500. Over 50, that's 26,000. A huge amount compared to a Roth IRA where it's $6,000 if you're under 50 and $7,000 if you're over. Let's take a look at Tiffany's example. So Tiffany is a 45-year-old doctor and is the only employee of her S Corp. So she qualifies. She pays herself $120,000 in W-2 wages, which means her total contributions are $49,500. Remember, she's only looking at those W-2 wages. Maybe she's also doing a K-1, but because she's an S Corp, you only look at those W-2 wages to base your contributions on. So here's the breakdown. Employee contribution, $19,500. Employer contribution is $30,000. Tiffany elects to contribute the full employee contribution to her Roth. So all she does is deposit those Roth contributions into the Roth bucket of her trust checking account or brokerage account. If you guys have not checked out our contribution calculator, you can find it on our website. It's a great starting point. You, of course, always want to double check your contributions with your CPA or tax advisor. As you can see here, the individual 401k, that's your solo 401k. And it's also comparing it to other contributions with other, comparable retirement accounts. Look at that difference. So that's a very, very large difference. Our contribution calculator also breaks down the salary, the employer contributions and the employee. So you can see right there, that is the breakdown. So like we've discussed, the limits for 2021, 19,500, and the catch up.
Awesome. Let's go over some best practices and logistics for these Roth contributions. So, for the Roth 401k, to utilize the Roth 401k, you may want 3 bank/brokerage accounts, per participant. This really depends if you're going to do contributions also to traditional or pre-tax. You also might do that mega backdoor Roth strategy that we talked about on a previous webinar. So you might want to have that voluntary after-tax bucket as well. The most that you could ever have would be 3 per participant. So that would mean 3 for you. And if your spouse is participating on the plan, they might also have 3. So the max is really 6, right? Now, basically, why would you want to do that? Well, you want to keep things separate by tax classification because you are your own plan administrator. So you want to keep good, accurate, detailed records. You're the trustee. You are the record keeper. So it's really your responsibility to ensure that you're keeping good records for your plan. So it's good to have those separate accounts. That way you can keep things nice and neat. It really keeps your record keeping super simple, makes it easier for you on the back end. So you typically would have 3 buckets, right? You have the pre-tax funds, which are your traditional, and you can just nickname these accounts just like this, right? So a lot of times on the bank, portal or on the brokerage portal, you can just nickname these. They're basically sub-accounts, really. It's all under the same solo 401k trust structure, but you just have these sub-accounts. You can name them each pre-tax, Roth, and then you could also name the other one after tax or non-Roth, because not all after tax funds are Roth. We went over that in detail on the previous webinars. So if you haven't seen those, go back and watch that. But yeah, you can have those 3 different buckets. A little visual, obviously a lot of times a visual helps as well. So that's exactly what it would look like. You'd have a pre-tax bucket. That's where your employee and employer contributions would go that are pre-tax. Your voluntary after-tax contributions can go there. And then if you're making any direct employee contributions to Roth, those can go directly into the Roth 401k bucket. Awesome. And then obviously, you could have also the spouse. So this is exactly what I was talking about. So quick visual, this shows you really the maximum accounts or sub accounts that you would ever have would be 6, right? You'd have a traditional for you, traditional for your spouse, voluntary after tax for you, voluntary after tax for your spouse, Roth for you, and Roth for your spouse. A little bit of logistics about the bank account. Having distinct bank accounts for each participant and tax classification. Again, that will keep your record keeping so much more simple. It does allow you to have those different classifications, traditional, Roth, or voluntary after tax. Keeps them all separate. Also allows you to easily complete in-plan conversions. So if you don't know why that's important, go back and watch the mega backdoor training. But you want to keep those distinct and separate for a lot of reasons. That way you are keeping detailed records, keeping things separate from a tax perspective, and it helps you on the back end when you do maybe either close down the plan and you roll to like an IRA to an individual retirement account, or when you do distributions out of your retirement account. Obviously, you're saving this money into this retirement account so that one day down the road, you can pull distributions. So we want to make things as simple as possible for you on the back end. You can always refer to all the other various webinars that we have on voluntary after tax, mega backdoor Roth, pre-tax contributions, employee salary deferral, employer, all kinds of great webinars on contributions that we've done. Yeah, and again, just reiterating, keep accurate records. You are the plan administrator, so really, and we've done great trainings on like what your roles and responsibilities are in the solo 401k. You want to keep a historical record of all transactions, money coming into the plan, out of each bank account for each tax classification, record keeping of all contributions, record keeping on all in-plan conversions, proper filing of any forms with the IRS documenting those in-plan Roth conversions, and maybe that 1099-R if that's necessary. So, what are the best practices for that? Well, a lot of people choose to just use like a spreadsheet. Some people choose to have it on QuickBooks, Sometimes, you could just upload your forms into the Nabers group dashboard, right, where you keep all your documents. You can keep all your forms there. Also, some people maybe choose to hire a bookkeeper to do it, right? If you have a lot of, private investments that you're doing, maybe that's worth it to you to keep track of those things with a bookkeeper, right? It is, I mean, all of us are small business owners, so just kind of account for the cost of it. Maybe it's worth it to do that as well. Obviously, your time's worth a lot, so just keep that in mind. So here's just a quick example of, record keeping. Basically, this is different transactions that are happening within, maybe the bank account. This is an example of like a Solera account, different transactions showing, various amounts of money coming into the account. So really pretty simple, right? Just basically just on a spreadsheet. Also, we do have a handy contribution form. So when you guys are making those new contributions, whether they're Roth or they're pre-tax, you want to designate that on this form. You do want to formally elect your contributions before the end of the year. So this is where you would do that, right? You just keep this as your own personal records, print this form off, sign it, date it, put it back into your solo 401k dashboard for your own records. Remember, you're not submitting that up to us. You are the record keeper for your plan, so you're keeping that for your own records.
Perfect. Thank you, Eric. So let's discuss Roth 401k investments. What can you invest your Roth funds in? Anything that your solo 401k allows you to invest in, you can use your Roth funds. So real estate, cryptocurrency, brokerage, private lending, etc. Anything you use your pre-tax funds can also be used for your Roth funds. You are not limited here. We do get that question sometimes, so it's all within your plan. Go ahead and do your investments. You might want to consider using Roth funds for investments that may yield a high return, that compound interest that you're making. So something like cryptocurrency, investing in a startup business, or venture capital funds. Remember, this is not tax advice or investment advice, just us kind of talking about the benefit of having, the Roth account. You're not going to pay any taxes upon those distributions. A little recap. So you can fund your Roth 401k with rollovers or new contributions. Roth 401ks can only receive employee salary deferral contributions. Roth 401k contributions can be 100% of your salary with the max of the $19,500 if you're under 50. And of course, you're keeping those bank accounts separate for your sake, for easy record keeping. So we have a few questions that Eric and I are going to ask each other. They're common questions, just in case you were wondering. So I'll give the first one to you, Eric. Can I roll over a Roth IRA into a Roth 401k?
No, you cannot. The IRS says no. It is kind of a weird rule, but yeah, once a Roth IRA is in a Roth IRA, it's a terminal destination, meaning it can only roll to other Roth IRAs. So no, that one is no. Also, can I mix Roth and pre-tax funds in one investment?
Yeah, you absolutely can. But what's really important here, you're keeping those good detailed records. That is the theme of all the presentations that we give. Detailed records are super important. If you're going to do an investment with a mix of funds, make sure maybe 20% of the funds came from Roth, 80% from pre-tax. So if you're getting any returns, it's going back in, same percentages. So if it's $1,000 in a return that you're getting, make sure that 200 goes into the Roth because it was 20% and 800 into the pre-tax. So keep those records straight. But yes, you can use both funds in one investment. Okay, the next question. Where do I report my Roth contributions on my tax return?
That's a good one. Well, it's not going to be a tax deduction. So where do you report that, Alana?
You don't report it anywhere. You're going to just report it in your own records. Yeah. So fill out that contribution sheet, put it on your spreadsheet. But yep, because you're not getting that tax deduction, there is no need to report it.
Absolutely.
Perfect.
Another one is, do I have to pay more to have a Roth 401k in my plan?
I do get this question every day. And no, you don't, which is great. Your plan as is comes with everything you could possibly need. The traditional component, the Roth, the voluntary after tax, in-plan conversions, alternative investments. I mean, we have people, I've had calls where they ask, I want to do crypto, but what if I want to do real estate down the line? Do I need to ask you guys? Do we need to change the plan? Nope. You guys are getting the most flexible, most up-to-date plan, and you're ready to do what you need to do. Okay, what is the difference between a Roth 401k and a Roth IRA?
Yeah, a few differences. Roth 401k, they're both the same designation. So they do both have the same idea that qualify, as long as distributions are qualified, they're tax-free. So that's the super exciting part. Roth IRA has a couple extra rules around, when you make conversions, but essentially they're really similar, right? There's a pro rata rule for Roth IRA when you're doing a conversion. Let's see what else is different. Well, contributions are much higher to a Roth IRA with the Roth 401k. We went over that all the way up to $19,500. With a traditional IRA, contributions are $6,000 with an additional $1,000 catch up, so that's up to $7,000 if you're 50 or older. Whereas the Roth 401k all the way up to $26,000 if you're 50 or older. So contributions are a little bit lower with the Roth IRA. Any other differences that you can think of, Lana?
Yeah, so there's no RMDs for a Roth IRA. So a lot of people, when they get close to retirement, will roll their Roth 401k into their Roth IRA. But just be aware, if you're rolling out of your solo 401k Roth, you might be losing your self-directed and allowable investments in alternative assets. So always keep that in mind and strategize with your CPA.
Yep. Another question is, what's the difference between voluntary after tax and Roth?
Yeah, so Eric said it. We love to say it around here. All Roth is considered after tax, but not all after tax is considered Roth. So if you're making voluntary after tax contributions and you're not converting that into Roth, you are going to pay taxes on your gains. So just like pre-tax, you'll be not getting that great benefit of the Roth. So most people do like to move their voluntary after-tax contributions over to the Roth so they can get that tax-free status upon distributions. Great round of questions. And of course, guys, like we've gone over earlier today, our support, you guys have unlimited access to free trainings and support from us. Of course, we want you to utilize our network, website, and knowledge base. We have created them for you guys. And of course, you can call us, email us, or chat on our website. Here is our contact information. If you're not a client yet, jump on a call with Eric or I. We would be more than happy to go over your specific situation. You'll get a free 30 minutes with either me or Eric. And if anyone needs to email us, our email is info@nabers.com. And you could always give us a call.
Awesome.
Okay.
Looks like we had some questions come in. Guys, any questions that you have, post them down in the bottom where it says ask a question. The chat box we can use to kind of, chat back and forth, but the question box is where we do the question and answer. So any questions you have, feel free to post them down there.
Yep. And I'm going to pull your questions. Whoever did post questions over there, I am pulling them and I will get them into the chat box. But ongoing, if you guys can use the chat box, that would be great. Bear with me. Okay, let's jump into the first one. Okay, the first one comes from Nick. I have a pre-tax solo 401k account where I've been making contributions for years. I'm planning on doing a Roth conversion. I've opened another non-custodial retirement account, basically creating a second account to house the Roth. Awesome. And we'll be converting the pre-tax money to the Roth. Question 1, what documentation should I maintain?
Yeah, great question, Nick. With the in-plan conversion, you do want to complete our in-plan conversion form that's in your document dashboard for the solo 401k. Also, you do want to file a 1099-R. So the 1099-R, in your case, since it's coming from pre-tax, that those funds did not have taxes paid on them, right? So you will have to pay tax either now or at the end of the year. And that 1099-R is going to document that it's an in-plan conversion, but really they consider it like a distribution. So that distribution has taxable implications. You'll pay the tax, and then you'll document that with the 1099-R. If you don't have a good CPA that is an approved filer for the 1099-R, we have a great article going over how to do that, as well as some resources of 1099-R providers that can help you with that, filing that form.
And then the second question, Eric, you did touch upon it. What tax filing requirements do I have? So you talked about that 1099-R. And so then for the third question, anything I should be thinking about related to the potential tax law changes?
Nothing in particular, Nick. The proposed legislation, we have an article about that in our network. So if you haven't joined Solo 401k Network, go in there and search for the article, or we can maybe post it for you. But yeah, there's nothing prohibiting Roth conversions. There is some language around maybe limiting them in like 10 years from now. So, but it's mostly for people that earn like quite high income. So 400,000 for a single person and like 450 for a married couple. So, we cover that in depth on a webinar as well. It's still a bill. There's no law that's been passed. So thankfully we don't have to follow every bill that's proposed in front of Congress, because that would be pretty crazy. Disaster. And a lot of those, those proposed changes end up getting changed in the final revisions. So, but we are monitoring that closely and can let you know if we find out anything else.
Great. And then Nick does have a follow-up here. He says anything 5,500 related. If you're talking about with like Roth contributions, there's nothing related to that. You don't have to document that there. That form 5,500 EZ is when your account is at $250,000 or more. It's just an information gathering form. We help you with it, guys. We start sending out reminders about it in March. It's not due till July 31st. So don't fret too much about it. We have your back on that. So thanks, Nick, for those questions.
Let's see. Another one from Rami. He said, thank you, Alana and Eric, for your dedication. Great knowledge you offer to the community. My wife has an S Corp. I am a trustee and have traditional/Roth. If I open a business myself, question, can I join the new business under the current trust name created under my wife's S Corp, so I can use the same Roth traditional accounts I currently have instead of having two of each?
Yeah, so Rami, potentially. So, we would make something called a controlled group plan for you. But what's important here is that your wife needs to compensate you from the S Corp. And then you also have to compensate your spouse from your business for you guys to be on the same plan. So something to think about. That's how you're going to get yourselves on the same plan, is if you guys are both being paid. You guys don't need to be business owners. Like, you don't have to be an owner of her S Corp and vice versa. What's important is that you're both being compensated from each other's businesses. So great question, Rami. If you're not going to do it that way, then you would need two plans. And of course, if you have two plans, it gets a little more complicated, no investing together. So if you can make it possible to be on the same plan, go for it. Definitely talk to your CPA and strategize. And of course, if you ever want to jump on a call about controlled group plans, let us know. It's a little complicated.
Yeah, and we do charge $75 administrative charge to set that up. So pretty nominal fee to have that ability to have both of you on the same plan.
Yeah, it's cheaper than a whole nother setup plus the annual for the second plan. So Good question, Rami. The next question is from Hector. W-2 S Corp net compensation, does that equal my gross minus all the taxes paid, including federal withholdings?
So Hector, for S corporation, I think you're probably trying to determine contribution abilities. So when you're determining contribution abilities for a S corp, that is solely based on your W-2. So nothing else is included in calculations for that. So you calculate the salary deferral based on that. You also calculate the profit sharing contribution based on that. So just W-2 wages, that's all you have to be concerned about.
Perfect. Good question, Hector. Good answer, Eric.
All right, which one are we doing next?
FB.
FB. Okay, FB has a question. It says, Lisa is under 50 and Lisa has a self-directed solo 401k with Roth for Nabers with Nabers Group. In 2021, Lisa pays herself a salary of $30,000. Lisa can use the backdoor Roth to contribute up to $30,000 to her Roth. 19,000 employee plus 6,000 Roth plus 4,500 voluntary after-tax contribution.
Yeah, FB, I love you always give us our examples back and change them around. I love that you do that. So yeah, it sounds like you're correct there if I'm crunching the numbers pretty fast. For anyone that is listening, this has to do with voluntary after-tax contributions. It's a way to get more funds into your plan. And definitely refer back to our other webinar all about after-tax contributions. You can actually contribute up to 100% of your net earned income, but of course you cannot contribute more than you make. So Lisa making $30,000, the total contributions can only be $30,000. So if you add all of FB's numbers there, that should come out to $30,000 because you can't max out more than that. So if FB did his math right, then yes. Perfect.
Yeah, just be a little careful too, because you have to account for taxes too on Roth because you're paying those contributions after tax. So double check your numbers on that because you do have to account for taxes since you're not doing those pre-tax.
Perfect. Thank you, Eric.
Mm-hmm.
Okay. The next question comes from Hector. What are you doing with the voluntary after-tax being at zero at all times since the money is being transferred to Roth? Oh, he said, I mean the bank account with Solera. So
yeah,
what do you
you're right. It stays empty most of the time, Hector. So yeah, you're really not using it. You're not leaving it there typically for more than like a day or two. It's really just there. For most people, it's just there to execute the mega backdoor Roth. And so, yeah, after a day or two, you typically do just move it over to Roth.
Perfect. Yeah, and I think it's no problem. So I know a lot of banks, they require you to have like a minimum balance, but like with Solera, it's the minimum balance for all three of your accounts. So it's okay to keep that one at zero. The rest of the accounts just need to have more than $50. So great question, Hector.
So a question from David says, hi guys, can you explain the difference between Roth and mega backdoor Roth?
So yeah, you're going to want to refer to our last events. I'll touch upon it a little bit, and I'm going to put a link that you can get to all of our last previous events. And John, I see you wanted this as well. So in our network, if you go to the past events, you'll find all of them. And we went over all of the Roth, all of the mega backdoor Roth. So the Roth is, is the tax designation for a portion of your contributions. The mega backdoor Roth is the strategy. So it's a way, because remember, so what we've gone over is that you can make your max is $19,500 for the Roth contributions. The mega backdoor Roth gives you the ability to possibly put $58,000 in there. So it's a advanced strategy, and we did go over both voluntary after tax, and we went over the mega backdoor Roth. You need those components along with the in-plan conversion, and then you can complete the mega backdoor Roth. So check it out, David. John, check out our other events too. I think you guys will really enjoy them.
Yeah, we're just talking about the front door strategy today. Just going right through the front door.
Okay, the next question is from Karen. I'm a 65-year-old sole proprietor and do not pay myself a wage. Can I contribute my net profits up to the same $64,500 to either the 401k or 401k Roth?
Great question, Karen. Yeah, a sole proprietor or like a single member LLC, taxed as a sole proprietor. Yeah, you calculate contributions based on your net profits after deductions, after expenses. So that being said, you can't just put the full 64,500 into one specific area. There's different ways to calculate your contributions. We've covered a lot of that on previous webinars. And we covered a little bit of it today. You have the employee contribution, you have the employer contribution. You also have voluntary after tax. So the more that you earn in net business profits, the more that you can contribute tax deductible. And then if you want to do after tax contributions, you just have to make sure you have enough there after taxes and business expenses to contribute that back into your solo 401k. So the simple answer is yes. Net profits is how you calculate contributions. A great place to start if you're looking to do, pre-tax contributions and have those be deductible. Go to our calculator, solo401k.com/calculator. Lana went over that a little bit in the presentation. That's a great place to start to see what you can do for contributions. But then also, watch our different webinars, check out the knowledge base. A lot of great articles on how to maximize your different contributions.
Perfect. Thank you, Eric. I also posted the calculator over there. You guys can go ahead and check it out.
Another question from Ball says there is suggestions to set up solo 401k LLC once you set up 401k with Nabers. Can you explain why or if it's necessary to establish the LLC for investment? Do you need one LLC for each of your contribution buckets?
Great question. So one LLC is fine. It really depends. So this is why the LLC is so great. It gives you an extra layer of protection. So all of you real estate investors out there, if you want to do like rental properties within your 401k, you might want to think about getting this LLC. And this is how people structure it. They'll put their brokerage, their cryptocurrency, things that you can't get sued from under their trust name. And then they'll do maybe their rental properties in their LLC name. So if someone wants to sue you from that rental property, they can't touch anything else in the trust. So that's where you get that extra layer of protection. And then how you use it is, you have your trust checking accounts, but then you also have your LLC bank account. So all new contributions, rollovers, they're going to go into your trust checking account. And then you just wire it over to the LLC account. And if you're using the LLC for investments, funds need to flow in and out of that LLC bank account. So you do not need multiple LLCs for your contributions. If you're going to, you can. I mean, you absolutely can have one LLC for Roth, one LLC for traditional. Sure, if that's what you want, great. Another option is keeping track. So if you're wiring, 20% of Roth funds into the LLC, and 80% of traditional into the LLC, you're always keeping good track. That's what's most important. So great question. If anyone here is interested in getting a special purpose LLC and do not have one, reach out to us. Shoot us an email at info@nabers.com. So great question, Bal.
I guess they could conceivably have sub-accounts in the LLC too, probably, possibly.
Mm-hmm. They could have multiple LLC bank accounts for sure. So great addition there. Yeah, you can really have as many bank accounts as you want. So perfect. Yep. And that can definitely help with record keeping.
Yep.
I think this is more of a comment from Hector. Detailed records, ? 99.9% of entrepreneurs' records are very detailed. You would hope so. And if not, get a bookkeeper. Okay. So the next question comes from Doug. Can one fully fund a Roth IRA and a Roth 401k in the same year? Great question.
Really good question, Doug. Yeah, you can. So the Roth IRA, so IRA limits are individual retirement account limits, and that's not with respect to your solo 401k. Solo 401k, you can do both, basically. You can do, if you have a sponsoring business and you have earned income from your business, then you can contribute to the solo 401k. If you have enough earned income also additionally to do the Roth IRA, then you can definitely do that too.
Yeah. Unless you're hitting that income ceiling, you may not be able to do the Roth IRA, but beyond that, you can totally do both.
Yeah, that's one other difference we didn't cover. The Roth 401k, there's no income limitation. So you can make as much as you want and contribute to a Roth 401k. Versus a Roth IRA, you do have income limitations.
Yep, exactly. Thank you, Doug. Awesome question.
Really good. Another question from Adam said, can you fund a Roth 401k with stocks from a trading account?
So a few things here. So you could have a trading account for your Roth funds, but I don't think that's the question that you're asking. I'm wondering if you're asking, are you making money from your stocks? Or you're talking about trying to put some of your earnings from stocks into the Roth 401k? You do have to have some kind of special accreditation to be a trader. So if you have that, maybe. Also, my question to you, Adam, is if you're a client with us, what's your sponsoring business? So it's going to be your sponsoring business and the income from there that is going to decide what you can contribute to that Roth 401k. So
yeah, you might be asking, that's, yeah, and it's a little bit, maybe if you're on here still, Adam, just clarify for us. But yeah, you definitely cannot contribute stocks like in kind, like the assets themselves directly into your solo 401k. You can only contribute US dollars. So it has to be from your business that's sponsoring the 401k.
Perfect. Good question, Adam. Thank you. We get that question a lot. People want to, put their crypto in, and you can't do that. So USD only. So thanks, Adam, and thanks, Eric. Okay, the next question comes from Phil. What is the limit for voluntary after-tax contributions?
Yeah, the limit is the full limit. So, and that what's nice about that is it's irrespective of any other salary deferrals that you've had maybe in another job. So maybe you have a job over here, big group 401k plan that you're participating in as an employee of a company, and you've already done your max over there. Voluntary after tax for your solo 401k is still all the way up to the full limit. So 58,000 if you're under 50 and 64,500 if you're 50 or older. So yeah, all the way up to the limits. Keep in mind though, you do have to have made the money in that sponsoring business, right? So you can't just contribute any money that you made like over on the side. It has to be from the business that's sponsoring the 401k plan.
Yeah. That, and if you're, let's say you're making like a 10,000 contribution to your traditional, you have 48,000 left over for voluntary. Right. So you can't just stick 58,000 if you're already contributing to the solo 401k. So crunch your numbers. Great question.
Another question from Sean. He said, I've heard that the new tax law is coming out to make the solo 401k not as tax advantaged as they have been. Can you comment on some of the advantages that are going away?
Yeah, like we've discussed, Sean, it's kind of hard to comment on any of it because it's a bill and we don't follow bills. So we don't want to get into it too much. But what I can tell you is if this bill becomes a law, most likely it will be watered down. There might be some grandfather clauses, and we will make sure to tell all of you guys how your plan has changed and if anything, if you guys are affected at all. So stay tuned. We will absolutely keep you posted.
And I'll say nothing so far that we've talked about, like direct Roth contributions are not going away. That's nothing in the bill has talked about that whatsoever. So what we're talking about today, the 19,500 as a Roth contribution, irrespective of income level, not going away, not even proposed. So there's still ability to contribute to a Roth 401k.
Awesome. From Glenn, will post-tax Roth funds that are used for investments be taxed?
I think, well, a couple things.
Yeah, go ahead.
You're probably talking about distributions. So in order for a Roth distribution to be qualified, you have to be 59 and a half years old and have had a Roth account of any kind where you're contributing for at least 5 years. Now there is another specific rule about like conversions that has its own separate 5-year clock. So if you do a conversion to Roth from a pre-tax or from the voluntary after tax, that has its own unique 5-year clock. But yeah, as long as the distribution is qualified, then it's completely tax-free, including the original principal plus the growth, which makes it a very powerful account because, you know, those high growth investments like crypto, like startups, all grow tax deferred. And then if you distribute them qualified, completely tax-free, 100%.
Yeah, let us know.
Yeah, I don't know if that answered your question, Glenn, but
yeah. And how I may interpret it is if you are using your Roth funds for investments, everything it's going to be tax-free. You know, if you're at retirement age and it's been there for 5 years, you're not paying any taxes. If you're using Roth funds for investments, you're getting that Roth status and you're not paying taxes on distributions. Mm-hmm. So let us know if we got that right, Glenn.
The question from Rami says non-Roth question. Sorry. Okay. Any creative way to get 401k plan loan over 50,000 or over 50%? Also, it's 50,000 for each husband and wife, correct?
Yeah, that's correct. So the only creative way is putting your spouse on the plan and your spouse having $100,000 in the plan, you having $100,000 in the plan, and you could each take the $50,000. So there's no creative way. There's actually no creative way to do anything that you're not allowed to do. I think I get that so much on the phone where people want to do these creative things that are prohibited transactions. If you're getting too creative, you're probably breaking IRS rules, and we don't want to do that. The next question is from Ball. At what age a minor can qualify to set up a 401k?
So a minor can't. They have to be 18.
No, they can.
Oh,
they can.
Really?
So a minor can. Yeah. So as long as that minor, of course, is getting compensation. We have a special application, and I think the parent has to be a trustee on the plan. But yes, we can. It's so rare. I think we've set up like 2 of them. But yes, it is possible. And that's why you don't know, Eric. We've only set up like 2.
Wow.
So
learn something new every day.
Yeah. So good question, Ball. Question from Adam. I'm about to start a new job that will issue stock options. No cost until exercised. Can I get these options into the solo 401k?
Yeah, good question, Adam. Most likely, no. So if they're being issued to you personally, if you were to buy them from yourself, that would be a prohibited transaction. I don't know if there's a way for you to, purchase options from someone else with your solo 401k money. That's possible. But yeah, no way to really once you have those options, you're holding them personally, really no way to transfer them into your solo 401k. It's just you would want your solo 401k to own them initially, and you can't really buy them from yourself or your spouse or any other disqualified person. So your parents, your grandparents, your kids, your grandkids. So, and then it really does also depend how much of the company you own too. So there's some kind of specific rules about that. I would refer you to an attorney or potentially the founder of the company or someone else might be able to help you with that.
Yeah. And I actually just spoke to someone today on the phone that was asking a question that was similar, and he wanted to sell the shares back to the company and then try to have his 401k purchase them. But, that's kind of like indirectly buying it from yourself.
Yeah.
So like I said, don't get creative. Don't get creative.
Yeah, that's called the step transaction, right? It's you're basically selling to yourself, but you just did another step in between. So it's it's what your intention was, right? So,
and that's for any investment. Like if you wanted to like buy a house for it, but then you sold it to your friends and then your friends sold it back. That's again, these creative ideas, like good for you for trying to think of them, but you don't want to do them. And then Ball had a follow-up for the minor 401k. Can a minor run his or her business? Yeah. I mean, that's the only way to qualify for the solo 401k, that the minor has to have some kind of self-employment activity. Okay. We have 5 more minutes left. I do see we have some questions here that do not pertain to the Roth 401k. We really do like to stick to the questions for the Roth 401k. So Turkey, I know that's not your real name. But if you want to post those in the network, that's a great place. So we can give you some feedback there. So, okay. Great. And then also we do have we have a whole webinar about participant loans. If you want to check that out, just click on the link that I posted over there about the previous events. Perfect. Okay, another great webinar. I'm kind of sad that the contribution series has come to an end. If anyone has any topics they want us to discuss, please let us know, because we're doing these for you. So we want you to be interested in it. We have some ideas up here, but we'd love to hear from you guys. Tomorrow, Eric is doing his crypto webinar with Rachel. So definitely check that out. I know those have been wonderful. And that's going to be at 3 p.m. Eastern. On Friday, I'll be doing a new account training for the solo 401k. So if you're not a client, check that out. That's going to be at 2 p.m. Eastern. And then, of course, join us every Monday for our live Q&As. That is at 6 p.m. Eastern. So bring your questions. Any question. Well, most questions.
I think the crypto one's at 6 p.m. Eastern. 3 p.m. Pacific. Yeah, I think you said, anyways, 6 p.m. Eastern, 3 p.m. Pacific. Yeah.
Be there, be square.
Be there, be square.
Okay, perfect. All right, well, awesome. Thank you for attending. Thank you, Eric. It's always great to have your help. And we will see you guys next time.
See you guys.
Mm-hmm.